Hey everyone, and welcome to this full-length financial modeling test simulation, designed to help you prepare for real-world project finance interviews. In this video, we are going to build a project finance model from scratch, just like you would be expected to do in a 2-hour modeling test for a job in project finance, infrastructure investing, or renewables. Here's a quick peek at the end result. This is the model we'll build together, a fully dynamic, structured Excel file that calculates unlevered and levered project IRRs, includes step sculpting to a target DSCR, then moves on to equity IRR, cash-on-cash yields, payback periods, and more, all based on a utility-scale solar PV project with a long-term fixed-price PPA, just like you would see in a real-world infrastructure modeling test. Before we dive into the modeling, just a quick note on materials. You will need 3 supporting files to complete this modeling test: the case study PDF, a SOFR forward curve for interest rate modeling, and a model formatting template in Excel. You can access all of these by clicking the link in the video description and hitting free preview on the course page. You will be asked to quickly create a free account, and once that's done, head to the download and files and get ready section to grab everything you need. These materials are essential if you want to follow along and get the full hands-on experience. In a real-world interview setting, you would typically receive just the case study PDF and perhaps a market reference like the SOFR curve via email, and be expected to return your completed model within a set time frame, usually around 2 hours. That's exactly the format we are following here. Take a few minutes to read the case study thoroughly before building your model. I recommend printing it out if that helps you stay focused. You'll be able to underline key information, highlight inputs, and avoid wasting time on things that aren't actually required. Alright, let's read through the case study together now. You are evaluating an investment opportunity in the country of Solenta, a jurisdiction with a stable regulatory environment and active government support for renewable energy development. The project is a 150 megawatt peak utility scale solar PV plant. Let's mark this. That has already reached commercial operation, is fully constructed. The project has signed a 30-year fixed price power purchase agreement, PPA, selling 100% of its generated electricity at the bus bar under a pay-as-produced structure. Now that's interesting. It sounds like there won't be any basis risk, and from the first looks it also sounds like we won't have to model any merchant revenues, which should make modeling the top line fairly simple. You are part of an infrastructure investment fund that requires a minimum equity IRR of 10%. Now that's interesting. So we certainly work on the equity side or sponsor side, and we are given a minimum equity IRR. So let's keep that in mind in case we need to calculate an NPV. A minimum equity IRR is typically used for the discount factor in an NPV calculation. Your task is to build a fully dynamic financial model in Excel from scratch, based solely on the information below and a downloadable SOFR forward curve provided in Excel. Okay. Objective: you have 120 minutes to complete this exercise. Your task is to build a dynamic, clearly structured financial model from scratch in Excel. The model should include a well-organized pro forma cash flow model, distinct input and calculation sections, dynamic calculations based solely on the provided assumptions and SOFR file, logical formatting and transparency suitable for a real-world investment screening. That essentially just means that we have to build a clean model. You are not expected to build a fully integrated financial model. Now that's very important. You are not expected to build a fully integrated financial model with an income statement, balance sheet, and cash flow statement. So that will save us a lot of time. And if you don't read that carefully, you might waste a lot of time modeling a balance sheet and income statement, although it's not even asked for. Instead, a well-structured pro forma cash flow model that captures the project's key financial dynamics and supports the required return metrics is sufficient for this task. Okay, essentially we just need to build a cash flow model that gets the job done. That sounds good. Required outputs. Once your model is complete, calculate and report the following return metrics based on a P50 production scenario. Unlevered pre-tax project IRR, unlevered after-tax project IRR, levered equity IRR. That already sounds pretty intimidating, having to model 3 different IRRs. Net present value, cash on cash yield, annually over the 30-year project life, and total cash on cash multiple over the full project life. And lastly, we are asked to model the equity payback period. Okay. Key assumptions. Now this looks like all the inputs we'll need for the model. Timing. Financial close is the 31st of December 2025. So please note that this is year end. And COD is the 1st of January 2026. At the very top it said there is no construction period. It's fully constructed. So essentially with the financial close on the 31st of December 2025, we are literally acquiring the asset on the date it starts producing electricity. And the project life is 30 years. So the test makers right here are pretty much screaming at us that we should use a yearly model and don't get lost with a quarterly or monthly model. No construction modeling is required. So that should make the equity and debt drawdowns pretty straightforward. Technical parameters. Installed capacity 150 megawatt peak. P50 energy yield is 2,100 megawatt hours per megawatt peak. Those are essentially just full out hours. Degradation 0.3% per year and plant availability of 99%. Note how we are not given any uncertainty for the energy yield production. So that essentially means we are not even in a position to model anything else but the P50. To model a P90 or P99 energy yield scenario, we would actually need the energy uncertainty, which is not given. So that should make it pretty straightforward for different cases. Revenue assumptions, power purchase agreement. Contract term 30 years starting at COD, price $75 per megawatt hour, with a price escalation of 2.5% per year. Now, as expected, we are not given any merchant revenue assumptions, which should make modeling the top line pretty straightforward. Let's move on to operating expenditures. We have O&M costs, $8,000 per megawatt peak, insurance and other OPEX. Note how the units here are all the same for the first 3 megawatt per year. Then we have land lease expenses, which are 2% of revenue. And we also have an escalation factor of 2% per year for OPEX, which differs from the price escalation for the PPA, which has been 2.5%. Working capital, ignore for this exercise. Now this again underlines that we should clearly use a yearly model. Don't get caught up in trying to model it super detailed. They're trying to make it easy for us in a test setting. You're not expected to model a monthly or quarterly model. Usually a yearly model is more than sufficient for these purposes. Capital expenditures and depreciation. Total cost fully in place, so I guess that's the turnkey price that it will cost to acquire the plant, is $1.85 million per megawatt peak. Note that we had 150 megawatt installed capacity, so our total cost for the plant will almost be $300 million. Depreciation straight line over 20 years. There's no comment on how much of the cost basis will be depreciable, so we'll just assume that we can depreciate the whole thing. Again, let's try to keep it as simple as possible. Financing assumptions. Now this is usually the trickiest part of any modeling test. We are given debt sizing parameters. We are constrained with a maximum leverage of 90% of total cost. Max debt tenor is 20 years. And we are given a target DSCR to sculpt our debt at a 1.3 multiple. Now this clearly shows that there will be circularity in the model. And there are different ways of breaking this circularity. And in this case study, I will show you how to do this in the most effective way for the purpose of passing a project finance modeling test. Then we have some interest rate assumptions, a debt margin of 2%, a hedging ratio of 75%, and a fixed swap rate of 4%. So the hedging ratio clearly indicates that we have a hedged and unhedged proportion of that notional. That means that there needs to be a floating rate assumption for the remaining 25% of unhedged notional. And that's what's given right here. Floating base rate used the provided SOFR forward curve in the Excel. So that's a supplementary file we've been provided with. So we have a floating forward rate base rate assumption that we'll have to plug into the model. Okay, I think we're almost done with the assumptions. Tax assumptions, corporate tax rate 25%. And again, we have a target minimum equity IRR of 10%. If you scroll back up, you will remember that we've been asked to calculate the NPV without specifying any discount rate. So let's keep that in mind. If we know that our target minimum equity IRR is 10%, this will be the discount rate to calculate our net present value. All right, provided supplementary file. You will be given one Excel file with the SOFR forward curve covering 2026 through 2060. All other inputs must be taken from this case study text. All right, so that pretty much wraps up the case study itself. And as you can tell, this setup is designed to reflect a real modeling test, the kind you would typically get from an infrastructure fund, investment bank, or also a renewable energy developer, or IPP. If you work through this from start to finish, you will get hands-on experience with the kind of thinking and structure that's expected in real interviews. Of course, in actual interviews, the challenge doesn't always look the exact same as it does here, and you might be asked to tweak your model live, maybe link it up with a full set of financial statements, meaning you have to implement a balance sheet and income statement, or even separate contracted from merchant revenue streams with different DSCR target assumptions, or run additional scenarios like the P90 or P99. In some cases, I will even want to see how you break circular references using macros. If you're looking to take your prep further and get ready for those more advanced tasks, I've created a follow-up course called How to Ace the Toughest Project Finance Modeling Tests. It builds directly on this model and walks you through exactly those extensions, the ones that typically tend to trip people over under pressure. You can find the link to that course just below in the video description, or within the case study PDF. Before we dive into the modeling, a couple of quick notes. This video is fast-paced and replicates real test conditions. I won't explain every single concept in depth. If anything feels unclear or you want to sharpen your skills further, our in-depth courses are always there to help you prepare more confidently for your test day. And with that, let's start building the model. Alright, I just opened a new file in Excel. Please, when you take such tests, always make sure to start from scratch. Open a new file and start with a new document. Don't use any templates, because what test takers will do very first is go to the info section and they will check when this file has been created and by whom. So if your file has been created before you took the test, that's a major red flag. So make sure you start completely from scratch and don't use any pre-built templates. Testers are usually very good at calling BS on this kind of stuff. All right, and the first thing we'll do is name our tabs. First tab is always going to be our inputs time independent tab. So we like to differentiate inputs from time independent and time dependent inputs. The second one we will call inputs time dependent. Then we have a calculation sheet. And lastly, we can also have an output summary. But for now, let's just start with our inputs time independent sheet. And what we can do first is some simple formatting. So let's just narrow those columns here, maybe to 2, the first 3. The D will always be the description. So we can widen this one maybe to 43. Then after the description, we'll always have our unit. So let's widen this one maybe to 13. Then we will have our actual inputs, which we might need a little more space for. So 16 sounds reasonable. And then these two are just placeholders. 2 is fine. Let's hide the rest here, Control 0. And let's name this sheet inputs time independent. Okay, let's flip back to our case study and we will scroll to our input section. Right here, key assumptions. So the first assumptions we have is timing. So let's pull in all the timing relevant info. Timing. And what we'll just do is copy this stuff, copy, paste, COD, copy, paste. We have a project lifetime. And this obviously doesn't look super nice. But what I don't want you to do is having to set up all the formatting yourself. We will for sure need to do some formatting because without formatting, the model will just not be nice. But we will need to make sure that we do that as efficiently as possible. So that's why I've prepared this styling guide for financial models for you. This wasn't part of the case study, but this is a template you can use for formatting models that you built from scratch in a very efficient manner. And what you will be able to do is pick up different styles from column E and simply just copy it. Let's just do that right here. Copy this one and paste it special, the format only, right here. And let's do the same thing again, hitting F4. When marking all these cells here. And we will do the same for our timing with a different header. Let's use the header 1. And this is how we will pick up different formattings. So when we hit Alt-HJ, we will have custom formattings right here that we can use for building the model from scratch. Cool. This will be given as a date, financial close. Same goes for COD. And the project lifetime will be given in years. For this one, let's pick up a unit style, which is down here. Copy this. Mark all of these. Alt HVST. Enter. So we picked up a unit style here. Then let's flip back to our case study. Our financial close is the 31st of December 2025. COD 1 day after. So we can write 31st December 2025. Hit Control 1. Date. Let's select US. Scroll all the way down. Let's select this one. It's best. So people don't get confused depending on the location. And this one will be the 1st of January 2026. Pick up this style here. Paste it special. Project lifetime was 30 years, so let's just type 30. Hit Control 1. We will make a custom formatting. In quotation marks, we can write years. Hit Enter. Let's go back to our formatting sheet. Pick up our input style right here. Alt HVST. Okay, we lost our formatting here, so let's do it again. Custom, actually date. This one. Custom, we have already created this one down here, so let's create this. Then we go to move on to our technical parameters. Copy, paste, install capacity. P50 energy yield. Degradation and planned availability. Hit Alt-J here, select the header 1. This was given in megawatt peak. Our energy yield is given in megawatt hours per megawatt peak per annum, which are essentially just full out hours. Then our degradation is also given in percent per annum. And our planned availability is given in percent. Okay, install capacity 150. Our yield is 2,100 megawatt hours per megawatt peak. Degradation 0.3%. And planned availability 99%. All of these are inputs right here. And for these larger numbers, let's pick up another format. Go to the formatting tab and we'll pick up a comma zero style. Alt HVS. Alt HVST, enter. Alt HJ input. So now we have a nice separator here. And now we also have all these formats here, so we won't have to keep going back and forth. All right, let's keep going. Revenue assumptions, power purchase agreement. Pick this up. Contract term. Price. And price escalation. Let's just write PPA price here. Term will be given in years. PPA price in dollars per megawatt hours. And escalation percent per annum. So we already have formatted years input here. So let's copy and paste this here. And the term is actually 30 years. Our PPA price is 75. And our PPA escalation is 2.5%. So let's pick up the format here and write 2.5%. That's also an input. Actually, first let's pick up our comma 2 style here, right here. So we see the dollar on the cents input. Let's move on to the next section, operating expenditures. Copy this. O&M, insurance, other OPEX, land lease, OPEX escalation, and working capital we can ignore, so that's good. Let's copy this style here and paste it here. Now O&M, insurance, and other OPEX have the same unit, which is dollars per megawatt peak per annum for these three. And land lease was given in percent of revenue. So let's write percent of revenue. And our escalation again is just percent per annum as well. And this is going to be 8,000, 2,000, and 10,000. So we can pick up the number style from here, paste it here. 8,000, 2,000, and 10,000. Land lease will be given in percent. So that is just going to be 2%. And our OPEX escalation as well. So let's just drag that down. All right, then we go to move on to the next section. That's capital expenditures and depreciation. Total cost fully in place. Depreciation. Let's actually just write depreciation tenor. Maybe in parentheses, straight line. So it's clear to the end user what we're doing here. Total cost is given in dollars per megawatt peak. So let's write dollars per per megawatt peak. And depreciation term is given in years. So for the dollar amount, we can pick up this number, format here again. That is 1.85 million. 1,850,000. Hit enter. Depreciation is 20 years. Let's pick up this here, 30 years. You can adjust it to 20 years. Format the heading. And let's move on to our next section, financing assumptions. We have debt sizing parameters. Let's bold this. Maximum leverage, maximum debt tenor, and a target DSCR P50. So we have two debt sizing constraints. Our leverage and our target DSCR, as well as our tenor, of course. That's header 1. Then we also have interest rate assumptions. Let's bold this. We got a debt margin, fixed swap rate, and I forgot the hedging ratio. All right, maximum leverage will be in percent. I'll max debt tenor in years. Target DSCR will be in multiples, just write X. And these three inputs will all be in percent, our margin, hedging ratio, and swap rate. So maximum leverage is 90%. Maximum debt tenor is 20 years, so we can just pick up this input from here. Target DSCR is 1.3. Select an input style, hit Control 1, and let's make a custom format. Let's use the one with 2 decimals and add an X in quotation marks behind. So that just looks a little more neat. That's also an input. And then we have a debt margin of 2%. Let's pick up 2%. We can just paste the style everywhere here. 2%. Hedging ratio is 75%. And our fixed swap rate is 4%. Nice. We're almost done with our inputs. Next are our tax assumptions. You got a corporate tax rate. And lastly, our return expectations with a target minimum equity IRR. Both of these will be given in percent again. So let's pick up the format here. Our corporate tax rate is 25%. And our target equity return is 10%. Let's format those two cells. And that was it with all our inputs. Let's clean up that sheet. Mark all these cells here. We can hide them. Oh. Hide. And although this took quite a while to set up all these inputs, it will make quite an impression if you took the time to really pull in all the relevant info out of the case study. And it will make your modeling part so much easier if you're already well organized and well structured. So unless you have a 60-minute project finance modeling test, I highly suggest to always take the time, set up the inputs. If you have sufficient time, this will save you a lot of trouble later on. And before we move on to our calculation sheet, let's actually calculate our annual energy production up here. So hit Control plus. And what we can do right here is write total energy generation. And that will be in megawatt hours per annum. Let's pick up a new style. We will pick up our in-sheet calculation style. And this will imply that we calculate something here. And our total energy generation is going to be our installed capacity, 150 megawatts, times our energy yield per megawatt. So that's 150 times 2100, which means that our solar plant produces 315,000 megawatt hours per annum before availability losses or degradation. Nice. Now we can get rid of the grid lines and we are done with our input sheet. Before we forget, let's save this. Okay, we can just name it Project Finance Model Test Case Study. Hit enter. And before we move on to our calculations section, let's actually pull in our inputs time dependent sheet. So our only time dependent input is our SOFR curve. So let's just grab the whole thing here, mark it all, copy, paste it here. Let's just do some basic formatting really quick. Control 0. And we can hide all of these rows here. Nice. Get rid of the grid lines. So now we're good with all the inputs. I think we're doing pretty well time-wise. So let's take our time here for the basic formatting. Let's grab the first three again and narrow those columns. Column D usually is the descriptive part, so we'll need more space. Something like 40 is good. Then we'll have our units again. Let's have a separating row in here. Then with these two columns, we usually pull in our information from our input sheets. So let's give those a little more width. Then we can have another separator. In J, I like to have the row totals. And all the other rows going forward will be our calculation part, where we actually model the project. And we can hop into cell B2. And let's call this basic project finance model. Mark a few cells here, hit Alt HJ, select the header 0. Now the first thing we'll do, and which also aligns with our inputs, is modeling our timing assumptions. So we'll write model timeline. And with the model timeline, I always recommend you to directly model your flags that you will need for the model. That's industry best practice and will allow you to have a super flexible model. First thing we'll want to know is our year. And then we typically have a start of period and an end of period. End of period. And let's start with that. So usually we always start with modeling our end of period first. So our logical first moment in the model, in our case, will be in column K, because in column J, we will have our row totals. So what we'll pull in here, the end of period, is our financial close date. Let's go back to the input section. This is right here. And let's hop here in the name box and we'll name this financial close. Hit enter. Make sure you use an underscore, financial underscore close. And then we are in K6 and we'll pull in financial close. Now, since we pull this information from a different sheet, we will need a style, an off-sheet style that clearly points that out. So pick that up, paste special formats, control 1, that's a date. Okay. And then the start of period in the next period in L5 is simply our financial close date plus 1 day. Already picks up the right format. And now we decide whether we want to have a yearly model, quarterly model, or a monthly model. In our case, I strongly recommend to do a yearly model, as we already discussed earlier. So we'll use our year month function. The start date will be the row above, comma, 12 months, which will push it to end of January 2026. Copy this, Alt HVST. So you see it actually jumps it to, it actually pushes it to the 31st of January 2027, which is why we always have to subtract 1 month here. So we actually end up on the 31st of December 2026. That's just how the year month function works. And then we can just drag this over. And before we decide how far we have to drag it, let's go to our inputs time dependent sheet and see how far this goes. It goes till 2060, which should be something around 35 years. So let's go over for like 35. Yeah, that's right. So our period ends 31st December 2026. And then we can also pull this guy till here, narrow this one, and hide all the remaining columns, Control 0. This will make it so much easier to drag over our formulas later. And now also really important, let's free some panes here so that we always have our timeline and our this on top and our descriptions on the left. So go to View, Freeze Panes over here, and you should be in cell K7 and then hit Freeze Panes. So now our timeline is locked, as well as our descriptive part on the left side. Now for the year up here, we can simply say this equals year of our end of period. Get this one over, Control R. And this looks good. So now we're good to go and move on to our flags, which are really important for the dynamics of the model. So for the first flag, I always recommend to start with the financial close, especially if you don't have a construction period. So flags are always binary, so it's either a 1 or 0. So let's have 1 or 0 in brackets. That's a unit style. You know what? To avoid wasting a lot of time, let's mark 200 cells or so and mark them all as unit, so we don't have to keep doing that. And then for flags, I always like to have a start and end period. Hit Alt H-J and select a table style for this, right up here. And interestingly enough, our financial close is on one specific date only, so we don't have a start and end. It's basically the same day, so this flag will look a little different than the other ones. So we can just pull in our financial close date right here. It's off sheet again, so pick up this cell here, paste the style over there. Then in column J, we will always have our row sum. So this will be the sum of all of these cells right here. Hit enter. And we can select a comma 0 style. And in addition to that, we also have a row sum style. Pick this up. Paste it here. Select our comma 0 style again. And now we are ready to model our first flag. So that will be an if statement. If our financial close date right here, hit F4, equals the end of period up here. Then we want a 1, otherwise a 0, hit enter. So we get a 1 right here, drag it over to the right, and you can see we only get one flag in the period where our financial close occurs. Let's pick up a custom format for our flags down here, copy this, Alt HVST, drag this over, and this makes our flag look much more visually appealing. Then let's go back to our inputs sheet and look what inputs are time relevant. So first of all, we have an operations period for 30 years for our project lifetime. Then we have a PPA term. We also have a depreciation term. And we have a debt tenor. So those are all time dependent inputs we will have to pull in for our flags. Let's start with the operations. Then we'll have a PPA term, depreciation, and debt tenor. Drag down all these units. Now the start date for all of these will be our COD date. So let's name the cell again in the name box. Just call it COD, so it's easier to pull that info in. So this equals COD. Hit enter. Pick up the style. Drag it down. That should be the case for all of them. Yes, that makes sense. And then we will need our EO month function again. The start date is right here. And months will be, for operations, 30 years times 12 months, close parentheses. That will get us 1 month too far, 31st January 2056. So we'll have to subtract 1 month, minus 1. Let's drag this down for the PPA term. And let's just replace this one with our PPA term in years. That is also 30 years. Hit enter. Let's do the same for our depreciation tenor. That is down here. Hit enter. Control D. And for our debt tenor, that's right here. Hit enter. Pull down our row totals. Hit Control D here, so we have the formatting, and we will need a new if function for the remaining flags. And this if function always starts with an AND because we need 2 conditions to be fulfilled. First of all, we need the start of period in K5, which we are anchored to the row only, so hit F4 2 times. This needs to be greater or equal to our start of period here. Here we need to anchor it to our column, so hit F4 3 times. And comma, the second condition is that our end of period, hit F4 2 times again, needs to be smaller or equal to the end right here. So hit F4 2 3 times to anchor it to the column only. Close parentheses. And if that is true, we want a 1, so the flag needs to turn on. If not, 0. Hit enter. Drag this over, let's see if it works. This looks good. Our operations last until end of 2055, which is in line with 30-year project lifetime. And then we can drag this down, Control D to the right, Control R. Let's see if we got the anchoring right. Let's just test randomly. Hit F2, and you can see all the references are correct, so that's great. And we are done with our model timeline and flag section. Next, I recommend to always model inflation or macroeconomic inputs. Let's just call it inflation here. And if you remember correctly, we have a PPA escalation and an OPEX escalation. Escalations are always given as index so that we can always easily multiply our revenue and OPEX assumptions with them. And to model this index, let's actually pull in our PPA escalation right here, as well as our OPEX escalation, which is right here. Hit Alt HJ. That's an offsheet item. And now this gets a little tricky sometimes. Now, if you go back to the case study, we are not given any base year assumption. So we don't really know when the inflation is supposed to kick in. If you run into such a scenario, what I would recommend to do is, we know the financial close is on the 31st December 2025 and COD starts on the 1st of January 2026. So I would argue that by end of 2026, a full inflation period has already kicked in. So the base year is going to be the 1st of January 2026 or also the 31st of December 2025, which is basically the same logical moment. So what we will do is here in this column for the 31st of December, we will set this to 100%. Let's actually format that as a (2) style. So this is an input, and actually that's a technical input. So let's pick up our technical input style here. So that's our base year assumption, (2). And to model an index, it's very simple. It's basically just the previous period times, in parentheses, 1 plus our inflation assumption. Hit enter, drag this down, and we have anchored this one time too often. So let's actually just anchor to the column, hit a 4 3 times in total. Control D, drag it over. Now you can see we have a nice index for our OPEX and PPA assumptions. Before we get going, we can group these guys here, this and this. And then, since we don't have to build a 3-statement model, I would recommend to start with generation. So we want to know how much electricity we will actually generate. And for this, let's start with net generation before our degradation, which will be given in megawatt hours. And for that, we can pull in our total energy generation that we calculated earlier. Hit enter. Select an offsheet and (2) style. Actually, (0). And just to make it a little more clear, let's just say this is our P50. Select the table style just so we don't get confused what that is. And do not forget about our availability assumption. So right here, we're given that our plant availability is 99%. So let's write availability. It's table style. Let's pull this in. Right here, Alt HJ, it's an offsheet item. We can pick up our row totals, and this will equal our total P50 generation, fully anchored. Oops, fully anchored, hit F4 once, times our availability assumption, hit F4. And then obviously we only generate electricity during our operation period. So we will multiply it with our operations flag. Hit enter. Alt HJ, that's a (0). Drag it all over. And you can see that after our availability deductions, we produce 311.85 thousand megawatt hours per year. So that makes sense. And now what you will often see, especially if you're supposed to model a solar park, is a degradation. So we'll call this degradation discount factor. This is only solar specific, but testers like to test this. This is in percent. And we'll pull in our degradation assumption, which is 0.3%. That's an offsheet. And this is basically the same concept as our inflation with a base year. However, this time it will be reducing over time and not increasing. So our solar panels will start producing electricity at 100% output, and this output will decrease over time because the modules will be less efficient. The formula is essentially the same. We refer to the previous period times 1 minus our degradation discount factor. Fully anchor this F4 close parentheses. And then let's multiply this by our operations flag as well. Hit enter. And we can format this as percent. Let's give it 2 decimals. Drag it over. See if that works. And you can see our degradation kicks in until end of operation. And at the end of the lifetime, our panels have degraded to 91% energy output versus the original 100%. Then we're good to go to model our net generation after degradation, which will also be megawatt hours. Pick up the raw total. And this will essentially equal our generation before degradation times our discount factor. Odd HJ, that's a comma 0. Drag it over. And let's give this actually a top border right here. And you can see that after degradation, we get 8.9 million megawatt hours before 9.3. Now we can group this together. And let's not lose any time. Next thing I would recommend to do is we have Capex assumptions, revenue assumptions, and OPEX. So I would suggest to put together Capex, revenues, and OPEX. Those are all the cash in and outflows the project will receive, besides taxes, of course. And here we can start with capital expenditures. Bold this. And we can actually just pull in the label that the test takers gave us here, the total cost fully in place. That will be in dollars. So let's pull in that info. Those are going to be $1.85 million. Alt HJ, 0 style. That's an offsheet item. And so we don't get confused with the unit. Let's write dollars per megawatt peak, or actually let's just pull this in. Just pull in the unit and give this a header style or table style. And what do we need to calculate overall capital expenditures? We will need our installed capacity. So let's pull this in as well. That is given right here. It's an offsheet item. Pick up the row totals. Okay, our total cost will be 1.85 million. Let's fully anchor this times our installed capacity. Hit the 4 once. And now we multiply this by our financial close flag. This is when the funds will actually flow out and when we will buy the solar park as is turnkey. right before operations. Hit enter, comma 0, let's drag this over, and you can see the total cost of the project will be $277.5 million. And these costs will be funded by a mix of debt and equity. And before we move on to modeling the debt section, we'll need to model our revenue and OPEX, and then we can also focus on our first case study task. Let's flip back to our case study. And here we are asked to model our unlevered pre-tax project IRR and our unlevered after-tax project IRR. So these are IRRs that are before our financing. So we essentially assume the project will be financed with pure equity. So let's keep that in mind while we go, because we should be almost there to calculate this. But of course, first we also need our revenues. Bold this. And we only have PPA revenue, but let's still call it total revenue right underneath in case we have to model merchant revenues later on. And for our PPA revenue, we will need our PPA price. Let's pull this guy in here, enter, give this a comma 2 style, off sheet. And to make things easier, let's just say this is in dollars per megawatt hour. Table header. Pull in the raw total. And to model our revenue, first we will need our total generation after degradation, of course, times our PPA price. Hit F4, and just in case we can also multiply it by the operations flag. Hit enter, drag it over. Let's see if that makes sense. We get PPA revenue until end of the period. And actually, you know what? Instead of multiplying it with our operations flag, which is unnecessary because the electricity generation is already covering that. But what we almost forgot, and be really careful with these material calculations here, we have a PPA escalation factor. So we'll need to multiply it with this, which will inflate our revenue quite a bit. And look at that, that makes almost a $300 million difference. So don't slip on this kind of stuff. Then we can calculate total revenue, pick up the raw total. That is essentially just the sum of the cell above. Drag this over. And for these type of calculations, I recommend using the account balance style right down here. And we can apply this all across. Alt HJ, we'll need a comma 0 style again. And you know what, let's just mark the whole thing here. Bold this. And you can also pick that up right here. So we clearly see what our total revenue is. Next, let's model our operational expenditures. And let's pick up the labels from our input sheet instead of wasting a lot of time and typing this stuff up. We don't need CPI. But this will be our total OPEX. All of it will be given in dollars. And we can pull in the info from our input sheet right here. This will all be an off sheet. This can be comma 0 and this was a percent. So we don't get confused with the inputs. Let's actually pull in the unit label. We can mark this as a unit. pull in some raw totals. Actually, let's also do it for down here. And then let's start with our O&M expense. This equals our $8,000 per megawatt peak install capacity. Let's anchor it 1, 2, 3 times F4 only to the column, times our install capacity, which we have up here. Let's fully anchor this one, only F4 once. Now let's not forget about our index again. That is right here in row 17. We will need to anchor this too, 1, 2 times with F4 only to the row. And lastly, we will have to multiply this with our operations flag, as the OPEX will only be due during our operations. Anchor it 1, 2 times with F4, hit enter. Drag it down, Control D, pull it over to the right. Let's see if we got it right. That looks good, except the land lease. This is in % of revenue. So what we will simply do here is pick up the 2% of revenue, hit F4 once, times our total revenue up here, drag it over. And you can see that we have 144 million in total OPEX versus almost $1 billion in revenue. So this seems to be a profitable project. Pick up this whole row here just for the style. Paste formats only, Alt VST. And this is going to be the sum of this. Drag it over. And now you might sense it. We are already ready to calculate our EBITDA, our earnings before interest, tax, depreciation, and amortization. Our EBITDA will be in dollars. Let's pick up a raw total. And this will be essentially just the difference between our total revenue minus our total OPEX. Drag it over to the right, Control R. Let's mark this whole row, bold it, Control B, and let's also give it a top and bottom border. And now that we have our EBITDA, we can calculate our pre-tax free cash flow. Pre-tax free cash flow, that's basically the cash flow available to the project. So this is before the consideration of any financing and taxes. So let's just pick up the whole format here again, copy, paste, just the format, Alt H VST. Pick up the row total here. And now our pre-tax free cash flow is going to be all outflows due to capital expenditures. So minus our Capex up here, plus our EBITDA. Okay, drag this over, Control R. Let's save it. Now let's flip back to the case study. And now we are actually in a position to already model our unlevered pre-tax project IRR. So write unlevered pre-tax project IRR. You can bold this. This will be in % per annum. And for this, you could technically use the IRR function, but the XIRR function is a little more precise. So write XIRR, select all the values, starting right here, comma, and then we will select the dates from K6 onwards, hit F4 to fully anchor this, not for the first selection, so we can reuse our IRR calculation later on, hit enter. Alt HJ. That's in sheet. Percent. Let's give it a couple of decimals and bold this. Now that's interesting. So we have a unlevered pre-tax project IRR of 8.24%. That is well below our minimum equity return of 10%, and that is even before we pay any taxes. So that clearly points out that without financing, we will never get to our target return from an equity perspective. But before we can calculate our equity return, let's flip back over to our case study. We are also supposed to calculate our unlevered after-tax project IRR. And to do that, we first have to calculate our unlevered taxes. And to do that, we will need to calculate our depreciation, which is tax deductible, and our unlevered taxes. Alt HJ, header 1. Let's start with the tax depreciation. Bold this, and this will be our depreciation in dollars. And for that, we will have to pull in our tax basis. And our tax basis is essentially just the sum of all our capital expenditures, which we have here. So let's pick up the row total right here, hit enter, and pick up a row sum. To calculate our depreciation expense in each period, which will be negative, we will say minus our tax basis, fully anchored F4, divided by, now we have a depreciation flag, our total row sum of periods in which the depreciation kicks in, because it's a straight line depreciation, hit F4 once, times our periodic flag. Hit enter, Alt HJ, 0, drag this over. And now we essentially just spread the full cost of the plant over 20 years for equal amounts. And this 13.875 million will be tax deductible in each single period for the first 20 years. Which allows us to now calculate our EBIT, our earnings before interest and tax. So let's pick up this format from here, Alt HVST, dollars, our row total from here, and that is basically our EBITDA plus, because our depreciation expense is already modeled negatively, plus K48, drag it over. And you can see that our earnings before interest and tax equals our pre-tax free cash flow. Why? Because we just equally distributed this expense over a period of 20 years to lower our tax basis. And that now allows us to model our taxes. So we can say less unlevered taxes. And on an unlevered basis, our tax expense will be higher because once you have financing, the debt interest under the financing will be tax deductible. So we will have to model our taxes on an unlevered and levered basis. To model our taxes, we need to pull in our tax rate. That's off sheet. Pick up the row sum. And that basically just equals our EBIT times our tax rate. Hit F4, 0, drag it over. And we see that we pay 144 million in taxes, and let's actually flip the sign here. So let's model this negative. And then we can model not our pre-tax free cash flow. So let's just pick up the whole thing here. But instead we model our after tax free cash flow. And then we'll have to adjust this, because this will be essentially our pre-tax free cash flow plus our negative taxes. Drag it over. That's interesting, that didn't work. Oh yeah, of course we don't have a negative pre-tax cash flow. Let's just do it from scratch. This is our pre-tax cash flow plus our unlevered taxes, which are negative. Let's drag it back over. And now we get our after-tax free cash flow of 433 million. So we actually have to pay quite some taxes here. And if you got the anchoring right, you can just copy this one here, paste it down here, and this should be our unlevered after-tax project IRR. Let's check if the reference is right. Yeah, we're referring to the after-tax free cash flow and the timeline up here. Hit enter. Now let's group these two sections together. Let's group this and group that. Well, now we are at a point in the case study where I would argue most candidates don't even get to. We have already answered the first two questions. And next up will be our levered equity IRR, for which we will need to model our financing. And don't get me wrong, although most candidates won't even make it to calculating those two ratios, this will be a much more difficult task than just modeling some basic cash flows, depreciation, and tax expenses on an unlevered basis. So without further ado, let's get going on our senior debt. This will be by far the most challenging section of this case study. Okay, and to model our senior debt, I always recommend to very first start with our CFADS, which are also referred to as cash flow available to debt service. This is a very important number in project finance. Cash flow available for debt service, or also called CFADS. And to arrive at our CFADS, we pull in our EBITDA and subtract our levered taxes. Both of which will be given in dollars. So essentially, whatever is left after our operating expenses right here and after paying our taxes will be available to lenders. So if you have our EBITDA and our levered taxes, we can model our CFADS, which are also given in dollars. First up, let's pull in our row sums and our EBITDA. We calculate it further up here. We can simply link it. Levered taxes, we do not know how many taxes we'll have to pay because we haven't calculated our interest expense yet. But we can already set up the formula for our CFADS, which is the sum of this. Drag these two guys over. And then we can use the same formatting for the CFADS as up here. And if we don't pay any taxes, our CFADS equal our EBITDA. But let's focus on our levered taxes now. Levered taxes, both this. And to calculate our levered taxes, let's just go through the typical income statement. And to do that, we will start again with the EBITDA. Then we will have to subtract depreciation. Which will bring us to EBIT. And here we'll have to subtract debt interest, because interest expense are tax deductible. So we'll have our earnings before interest and tax. And then after interest expense, we'll have our earnings before tax. And once we have those, we can calculate our lever taxes. All of these are given in dollars again. Pull in some raw totals. Now EBITDA is a simple linkage again, further up here. Depreciation, we have already modeled further up here. So let's simply link that. The sum of those two will give us EBIT. Our debt interest we don't know yet, so we just skip over this. Our EBT will be our sum of our earnings before interest and tax minus taxes. The taxes will be minus debt interest. The debt interest will be modeled negative, so let's just take the sum here again. Let's drag these guys over. This looks good. And then for our levered taxes, we will have to pull in our tax rate again. That's an off-sheet item. And this will simply equal 25%, fully anchored at 4 times our earnings before tax. Alt H8, that's a comma 0. Drag this over. And let's actually bold this as well. 2 borders. And right now our levered taxes still equal our unlevered taxes. Why? Because we don't have any tax deductible debt interest modeled yet. However, what we can do now, we can already link in our taxes up here. So this equals minus our levered taxes down here, which will reduce our CFADS by our tax expense, which leaves us with 710 million in CFADS roughly. And now comes the tricky part. So we will have to do some debt sizing given on our debt sizing constraints. And before we get going, I recommend to just pull the flag back in. So let's just write debt tenor. We want to know how long our financing lasts. And to do that, let's just pull in our flag again. So for the debt tenor, we had a flag up here. Let's pull in this, copy this, paste it here, and let's copy this, paste it here. The reference here is probably incorrect, so we have to go back to our debt tenor of 20 years. And then we should be able to simply pick up this right here, paste it here, drag it over. And this will make it a little easier on the eye to understand like when the financing is kicking in. So for the target debt sizing, we are given 2 constraints besides the tenor, which is a maximum leverage and a target DSCR under P50 scenario. So I suggest that we first pull in our target DSCR because we have our CFADS now. So let's just pull in the label from our input sheet. This is given as a multiple, and we can pull in our target DSCR of 1.3. Say that's an offsheet, control 1, custom, scroll all the way down and select this previously created style. And we can multiply this fully anchored, hit a for once times our debt tenor flag, control 1. Let's do the same style again, and let's drag that over. So this is only kicking in during our tenor. And then we can calculate our target debt service. Target debt service. And our target debt service includes debt principal and interest. That's very important. So to calculate our target debt service, what we'll do is we will take our CFADS up here and divide them by our target DSCR. And we'll get an error here because we can't divide by 0. So instead, let's just wrap it up by an if error statement. So if error, then we want the target debt service to be 0. Hit Alt AJ, select the comma 0 style, and let's drag this over. And you can see our target debt service only kicks in during our financing tenor. Let's pick up this row totally here. And we can see that we have a target debt service of roughly $345 million. And that is before we consider any tax deductible debt interest, which will likely increase our total debt. Now, why is this now very challenging? We don't really know right now how much of this will go toward interest and how much will go toward debt principal. So first, we kind of need to know what interest will be due on our total debt we will raise. So first thing we'll do is just pull in all our interest rate assumptions. Let's just write interest rates. We can underline this. And you might recall that we have a fixed swap rate and a hedging ratio, and also some SOFR forward curve, which is basically just a base rate floating rate. Depending on jurisdiction, you might have a LIBOR or Euribor. In the US, it's SOFR. So let's first start with our unhedged rate, which in our case is SOFR. This will be given in percent. And we can use a lookup function here to pull that info in. Lookup value will be our year up here, comma. And then we will look up our year, which is our vector up here, hit F4 to fully anchor it only once. And our result vector are the values right underneath. Hit F4 again, close parentheses, hit enter. And we get an error. Why do we get an error? So the table here starts in the year 2026, but our period starts in 2025. So let's just wrap it with an if error statement again. And if error, we just say it's 0. Alt HJ, actually, that's a percent. Let's give it 2 decimals. Drag it over. Let's see if that worked. So in 2029, for instance, we get a SOFR rate of 3.68%. So let's compare that to our table. So that's also 3.68%. So this seems to work properly. Nice. Then we have a fixed swap rate. This will be our fixed base rate, which was 4%, I believe. Yes, 4%. Off sheet. So we can just pull this in F4 times our financing tenor flag. Pick up the style from here. You can see that we get our fixed swap rate only during our financing tenor, because we obviously won't have a hedge beyond our financing. And that will give us our blended base rate, or at least it will allow us to calculate our blended base rate. And to calculate our blended base rate, we will need our hedging ratio, which is given right here at 75%, which is fairly industry standard. Let's write hedging ratio right behind, and we can also pick up a comment. Copy this. Alt HVST. So we don't get confused. And now this is our hedging ratio. So our blended base rate is equal to our hedging ratio, fully anchored, times our fixed swap rate, plus, in parentheses, 1 minus our hedging ratio, fully anchored, if for once, close parentheses, times our unhedged SOFR floating rate. Hit enter. So essentially, let's see if that makes sense. In this period, our blended base rate is leaning more towards a fixed swap rate than our unhedged rate, which makes sense because we are hedging more than we are not. So this seems to work properly. And you can see this relationship flips later on when our base rate is higher than our swap rate. So this seems to work well. Then we can calculate our all-in interest rate, which is also given in percent. And for that, we will also need our margin, because obviously we don't only pay just a base rate, which is basically a risk-free rate. Our commercial bank will also want to receive a margin. That's how they earn their money. So let's write a comment here, pick up the style from here. And the all-in interest rate is essentially just our margin fully anchored plus our blended base rate. And let's actually put that in parentheses and multiply this out by our debt tenor flag. Let's pick up the formatting from here, drag it over, and let's have a top order. So that was some quite heavy lifting just to get to our all-in interest rate, but this is, you know, the most advanced section of the project finance modeling test. And now it does get tricky, because now we have to determine our overall target debt service. How much of this will be principal and how much will be interest. Now, best practice is to implement a copy and paste macro, which will break a circularity, which we'll cost later on. But if you code a macro in VBA to break the circularity, you will need a lot of time, and you will most likely run out of time unless you're given a very extensive time period to finish that model. But in our case, we only have 2 hours. So what we'll do is the most effective way of determining this. And I show you how to do this with a NPV approach that even a lot of seasoned professionals don't really know about. And if you show that you can determine the overall debt principal without using a macro, with this NPV approach that I'm about to show you, then for sure your prospective employer will be very impressed. So let's start with the discount factor multiple. So what we will essentially do, that's an X, we will use our all-in interest rate in each specific period to determine an appropriate discount factor, which we will then use to calculate the NPV of our target debt service. And this net present value of our target debt service will be our allowable debt principal. Because essentially we're just adjusting for all the interest expense that will be due. And to do this, we will have a technical input again. This will be a 1 right here. And we will refer to this 1 in J83 and multiply it like a index with 1 plus our given interest rate in that period. It's important that you select our all-in interest rate. Close parentheses. And we can just select our customized style here that we also use for our DSCR. And let's drag that over. And to calculate the NPV now of our target service, we will have to actually flip this and calculate our PV discount factor, which is also multiple. And that's very simple. It's just 1 over our discount factor multiple. So we just flip that. Actually, just pick up the formatting from up here, drag it over. And this is the multiplicating factor that will get us to our NPV of each target debt service in each respective period. So what we can now calculate is our NPV of target debt service, which will be given in dollars based on our PV discount factor. So let's pull in a row total again. And this is essentially just our target debt service in the respective period times our PV discount factor. Hit enter, Alt HA, that's comma 0, drag it over to the right, Control R. So now you can see that our net present value of our target debt service is $191 million, which will be the allowable debt principal with the given target debt service of 345 million. So the difference between those two numbers will be the debt interest we will have to pay. So now that we know our target debt service, we can determine our final debt size, but don't forget about the second constraining factor, which is our maximum leverage of 90%. So let's just say max debt according to max leverage ratio. This will also be given in dollars. And our maximum leverage is going to be 90%. It's off sheet. So this would be 90% of our total Capex spend, which we have further up here. Right here, the raw sum. That's an in-sheet calc. So our final debt size, principal, is going to be the minimum of this row total and this cell right here. That's an in sheet, and let's bold this. Now, if you got this far, you're way ahead of the curve, and most candidates won't even get that far. But we are not done yet. Now that we have our final debt size, we can actually model our debt account. And an account is always the same structure. First, we have a balance brought forward, drawdowns, principal repayment, and a balance carried forward, of course. These are all in dollar terms. Let's pick up two row totals, but only for our drawdowns and principal repayment. And a debt account should always have an empty cell style right here. So let's pick up our empty cell style. Paste it right here. Why? Because for a account, we always pick up for the balance brought forward the previous period's balance carried forward. So we are referring to this cell right here. So we want to make sure no one puts anything in there. It's a comma 0. And this is the reason why we want this to be empty. This is going to be the sum of these three cells here. We can give this an account balance format up here. And our drawdowns, since we don't have a construction period, are just going to be our final debt size right here that we calculated right here, fully anchored with F4, times our financial close flag. Our financial close flag is all the way up here. ODHJ, that's a comma 0 style. And we don't yet know how our principal repayments will be structured. So let's just drag this over. And to calculate our principal repayment now, what we will need is our target debt service up here minus our interest expense. That's how much we will be able to repay our debt in a given period. But we don't yet know our debt interest expense. So we're almost done here with the financing section, but of course you will need a debt interest expense. Bold this, let's write it again, debt interest. Of course, it's very important. Get a row total in here. Now that's again pretty straightforward. We will have to pick up our balance brought forward. Don't use the balance carried forward. It's always the beginning balance times our all-in interest rate. So of course we have to pay interest on all the debt outstanding, but of course only during our debt tenor. So let's multiply it with the debt tenor flag as well. ODHJ, comma 0. Let's drag this over, Control R, and let's mark all these cells here. Have a top and bottom border. And right now we're paying a lot of interest, and if we add our drawdowns plus interest up, this number doesn't match our target debt service. And that's because we are not repaying any debt right now. So what we'll have to do is model our principal repayment to reduce the balance brought forward. So our principal repayment will be minus our target debt service. Let's actually put that in parentheses, minus our debt interest, close parentheses. Let's drag this over for now. Now this seems to work perfectly fine. However, let's just make sure that we get this modeled as flexible as possible. So what we will want to make sure that this is actually the minimum of the difference between our target debt service minus our interest, which is the first number. So let's add one more parenthesis here. And the second number is the balance brought forward. So obviously we don't want to repay more debt than we owe. And if your NPV calculation here wouldn't be properly set up, you might overpay your debt and your overall balance brought forward might turn negative. So let's put in this min function here to avoid this. Drag it over, Control R. And you can see that our principal repayment perfectly matches our drawdowns and ends right at the end of the financing tenor. And this is only possible because we back solve for our target principal by calculating the NPV of the target debt service using each periodic all-in interest rate. And that's a fairly advanced approach of determining the debt principal balance, but the most effective and fastest way, especially if you have limited time under testing conditions. Now we are almost done with our financing section, but you might be waiting for it. We should be having a circularity right here. And before we do anything, let's actually hit Files, Options, Formulas, and you can see our iterative calculations aren't turned on yet. Let's leave it like this. Make sure this box is unchecked, just for your understanding. And what we will link in now is our debt interest from down here. So our debt interest will be tax deductible. So our levered taxes will be lower. If our levered taxes will be lower, our target debt service will be higher. This will allow for more overall debt, which allows for higher drawdowns, which increases debt interest again. And if debt interest increases, our levered taxes will increase again as well. So we have a circular reference here. And what happens if I link this in, let's say minus debt interest, drag this over, and the moment I hit Control R, we should be getting an error message for circularity. There we go. Hit OK, and this is what we usually would break with a macro in a best practice model. We have a deep circularity because debt interest influences our overall CFADS, which then again influences our final debt size. And you can see for now we still have the old numbers of 191 million overall debt principal. But the moment we now turn on iterative calculations right here, we would expect this overall debt amount to go up because the debt interest will be tax deductible and increase CFADS and thus overall debt principal. Hit OK. And you can see that it now solved for a much higher debt amount, 211 million, instead of just 190 million. So we have a 20 million gain in debt principal just by the tax savings that increase our overall CFADS. Okay, and before we get going, I really like to always implement a couple of checks here. The first check is this. All the drawdowns plus our principal repayment should equal 0. And our template has a check style in place, so we can pick this up. It will show OK in case the cell contains a 0. If it's not a 0, it will contain a fail. So let's just paste formats here. And we get a fail. Why? Probably because of rounding issues. So let's just round this number here, this plus this, to 0 digits, hit enter, and we get a check. That's good enough. And let's implement another check, which we call check debt sizing. This will either be OK or fail. And this will essentially just equal our target debt service up here minus, or actually let's just say plus because our principal repayment is already negative. So negative our principal repayment minus our debt interest. So this number here should equal those two numbers together. Hit enter. And it gets us a 0. Let's pick up this style again. We will probably get a fail again because we haven't rounded the number. Yes. So let's round this number to 0 digits. Hit enter and we get an OK. Now, big congrats. We made it through the most complicated section of the modeling test. Group all of this stuff together. And now finally, we are in a position to model all of these equity multiples and return metrics. So this should be fairly fast. So not so much heavy lifting to do anymore. This will be equity. Let's have a header 1 here. And we will start with free cash flow to equity, which we also refer to as FCFE. Let's bold this. And this will be our dividends. So we don't have any complex shareholder loans or the like. So we just receive dividends, very simple. Dollars. Pick up the row total. So our dividends equal our CFADS up here. And now we have to subtract our debt principal, which is already negative. So we hit plus debt principal minus our debt interest expense. So after we pay the bank with principal and interest, we will get dividends. And CFADS are already adjusted for taxes, so we don't have to worry about any tax payments. Those are already considered. Drag this over. And you see that the equity investor will expect $375 million in dividends. Now the key question is how much equity will they have to contribute? So equity contributions in dollars. And our equity contributions equal our capital expenditures minus the debt we raise, minus our debt drawdowns right here. So this is only the principal. So we can drag this one over, and that will give us our net FCFE, free cash flow to equity. Let's pick up the style from maybe from here, just to have the same style. Control D, let's bold this too. This will equal our dividends minus our equity contributions. And now you guessed it, we are in a position to calculate our levered equity IRR. And once I pick this guy up here and paste it here, the moment of truth will come and we will see whether we hit our minimum equity IRR target of 10%. And there we go. We get 10.5%, and that will be our levered equity IRR. So yes, we do hurdle, and we can happily present to our investment committee that this investment opportunity will indeed fulfill our minimum return expectations after financing. So let's flip back to our case study. We are also expected to calculate our net present value. So let's do that now. Net present value, or NPV. For our NPV, first we need our discount rate, which is our target min IRR, given in percent. You can pull that in from our inputs time independent sheet. And the NPV discounted at target min IRR is going to be given in dollars. And we could use the NPV function, but it's not as precise as the XNPV function, which first asks for our rate, comma, our values, which are the same as for the IRR function, comma, and our dates up here. Hit F4 once, close parentheses, hit enter. Alt HJ, let's select the comma zero style, bold this. That's an in sheet. Let's bold it again. And we can see that our net present value is $4.3 million. So for $65 million investment, we have an NPV for $4 million. Now let's flip back over. We are also asked to calculate our cash on cash yield. Let's do that now. Cash on cash yield. In percent per annum. So this is going to be pretty straightforward. All we have to do is take our dividends and divide them by our initial investment, which is the row total here, anchored fully with F4 once. Let's select a percentage here, give it a couple of decimals, drag it over. And here is our cash on cash yield in each given period. For instance, in year 2029, we earn an 8% cash on cash, which is $5 million in equity that we get back for $65 million investment. Then we did this just now. We also need to calculate the total cash on cash multiple over the full project life. So for this, we can do the following exercise. We just take the row total of dividends and divide this by our equity contributions. Can format as a percent bold this AutoHJ in sheet. And let's write a comment here. This is our 30-year cash on cash multiple. That can be a comment style. You can also have a row sum here, which should equal the same. It does. Just to double check. So we did the math right. And now very last exercise we'll have to do is our equity payback period. And to do this, first we will need cumulative net FCFE, which we have up there. And again, we will need an empty cell here because we will be referring to this cell. And this equals this empty cell, the previous period, plus our net FCFE. Drag it over. And you can see that we get our money back between 2037 and 2038. So to calculate our payback period, we don't have to do anything fancy here, I would argue. This will just be in years, and what I like to do is I use a count if function. So count if this area here, if these cells, comma, in quotation marks, are smaller and or, so an and sign, 0, close parentheses, then I want to count them. So essentially all periods in which our cumulative net free cash flow to equity is negative is a period in which we haven't received our full initial investment back. And these are the periods I want to count. So the count if function counts each of these periods, and we should get something like 13. And we can double check this output. Let's just count the cells with a negative or 0 value. It's 1, 2, 3, 4, 5. And we get 13 cells which are negative right here. So let's format this cell as an in sheet, hit Control 1, custom, and select the previous year style that we created. Bold. Let's bold this one as well. We can group all of this together. And we have answered all our required inputs. So if you have some time left, which might look nice for decision makers, you could summarize all your findings in an output summary sheet, which won't be a big exercise, just summarizing what we just did so that they can clearly see you found all the values they asked for. Hit Control 0 here. And we can just name this case study outputs summary. It's actually the wrong format. Header 0. And a subheading could be summary of key outputs on a P50 basis. And then what we could do is we can group together all the IRRs and all the other metrics. So let's first write internal rate of returns, or IRRs. Bold underline. So we have our unlevered pre-tax project IRR. It's also a good way to double check whether you actually did all the work you were asked to do. And then we can call this other metrics. Net present value. cash on cash yield. Let's actually say average across 30 years. And we can also put in our total cash on cash multiple, say over full project life. And lastly, our equity payback period. Now the IRRs will all be given in percent per annum. And actually, you know what? Let's also pull in our minimum equity IRR. This is all in percent per annum. Alt HJ, let's formulate it as a unit. And pull in our findings. So for our unlevered pre-tax project IRR, that was calculated up here. 8.24%. After tax, 6.92. Our levered equity IRRs down here, 10.5%. And our minimum target IRR is 10%. So let's bold these three. These were asked for. Then our net present value is given in dollars. Our cash on cash yield is again in percent per annum. This is a multiple, and our equity payback period is given in years. Let's pull in our NPV right here. Comma 0 style, bold. Our cash on cash yield, say that is the average of, let's skip the first period because the investment essentially just starts on the 1st of January 2026, and select the first 30 cells. And that will give us an average of 19.04%. Now that is actually a crazy differential between levered equity IRR and cash on cash yield. And how come? That is typically the case if you have massive financing up front, because the IRR calculation values earlier cash flows way more than later cash flows. And what you will see with the cash on cash return is that it's fairly low in the beginning and then increases significantly and has a massive jump once the financing is fully repaid. So you can see this is in the period when the financing is repaid, and our cash on cash yield really accelerates in that period. Now our total multiple here is this 5.71%. We can actually just customize this as a multiple again, both this and this. And then our equity period will be 13 years. Okay. Bold. Now we can hide those rows here. Let's get rid of the grid lines. Very important, let's save. Obviously, we'll have to send this back via email, so make sure you save it often. Hide all these rows here. Oh. Let's also get rid of the grid lines. Save again. Let's actually save it while we're in the output tab so that decision makers clearly see the results very first thing. All right, and that's it. If you made it all the way through and built this model from scratch with me, huge congrats. This was not an easy task, and getting through something like this puts you way ahead of the curve when it comes to real-world project finance interviews. Personally, I've tested plenty of candidates over the years, and honestly, a lot of them struggle to even reach a financing section, yet alone the first IRR calculations. Now, if you would like to download the final completed Excel file and compare the results of this file to your file, you can get access by purchasing the full course on Renewables Valuation Institute, and it's priced at very affordably and gives you lifetime access to this course. And also, if you're serious about acing your test day and want to go even deeper and understand how to build things like three-statement logic, breaking circularities with macros, or handling more complex DSCR-driven debt sizings, you should definitely check out our follow-up course, How to Ace the Toughest Project Finance Modeling Test. That's where we take this foundation and push it even to a more advanced level. If you found this video helpful, I would really appreciate if you could leave a quick review or a comment. It helps others find this resource and keeps me motivated to create more. You will find all the links in the description below. Thanks so much for watching and best of luck on your upcoming test.